All right, welcome to this explainer. Today, we're diving into something that is literally reshaping the financial map globally. We're going to unpack an alternative financial model that fundamentally rethinks how money, risk, and business actually interact with each other. It's a model built entirely on ethical frameworks, and it's expanding fast, especially across the African continent, offering a really compelling alternative to the traditional systems we're all used to. If you've ever wondered what finance might look like if it were tied strictly to real-world assets rather than just the ticking of a clock, you are in exactly the right place.
So what if your bank couldn't charge you interest? No, seriously, just pause and think about that for a second. It kind of flips our most basic assumptions about how a modern financial institution operates totally upside down, right? For most of us, banking and interest are basically the same word. You borrow money, you pay interest, you save money, you earn it. But there is a robust, rapidly growing global system where that simply is not allowed. So how does it survive? Better yet, how does it actually make a profit?
Okay, let's dive right into this. First, we'll look at what this actually means beyond just being interest-free. Then we'll break down exactly how it works and dig into the ethical and business benefits. After that, we'll explore the massive financial opportunity unfolding right now in Africa, look at some real-world case studies on the ground, and wrap up with what this means for you, the power of choice.
Section 1. Beyond just being interest-free and dismantling the myths. Okay, before we get into the nuts and bolts, let's clear the air on a few things. First off, and this is a big misconception, offering this type of banking doesn't mean replacing a country's civil legal system. Not at all. It operates completely within a nation's existing regulated banking system. But to really grasp how it works, we have to talk about its foundational rule, the prohibition of riba. Riba is essentially the practice of earning a set, predetermined return merely because time has passed on a loan. Yeah, you guessed it. That's interest. In this alternative model, money isn't just some magic commodity that automatically grows simply by sitting in an account or being lent out. Instead, financial returns have to be tied to lawful trade, real investments, leasing, or shared economic activity.
And that brings us to the broader picture, Sharia-compliant finance. You see, it goes way beyond just chopping out the interest. Think of it as a comprehensive, ethical financial framework. It strictly limits things like excessive uncertainty, which is called gharar, and outright bans gambling, known as maisir. It also completely blocks financing for impermissible activities like alcohol or casinos. But here's the kicker. Every single financial arrangement has to be connected to a real, identifiable economic transaction. And a super important takeaway here is that you do not need to be Muslim to use this. It's a commercial service open to everyone who is looking for ethical screening and transparent structures.
Moving on to Section 2. How Islamic banking actually works. The mechanics of ethical finance.
So, the crucial point is, if a bank isn't charging interest, how in the world does it function and how does it make a profit? Well, the whole paradigm shifts from just lending out cash to actually facilitating trade and partnerships. Let's compare the two. In conventional banking, your return mostly comes from interest slapped onto a loan or a debt balance. You're basically trading debt. But with Islamic banking, the return arises through a lawful sale, a lease, an investment, a service, or a partnership structure. The finance is asset-linked. The bank isn't just throwing cash at you and demanding it back with an extra percentage on top. They're actually rolling up their sleeves and participating in a real, tangible commercial activity with you.
Let's break that down into 3 real-world examples to see how it's done in practice. First up is Murabaha. Say you need inventory for your business. Instead of giving you a cash loan, the bank actually buys the inventory itself and then resells it to you at a very transparent, agreed-upon markup that you pay off over time. Second is Ijara, which is basically leasing. Imagine a logistics company needs a new delivery van. The bank acquires the van, then leases its use to the company for a set time and price. And third, we have Musharaka, a true joint partnership. Here, a bank and a company might team up to jointly fund a new manufacturing line. They literally share the actual profits, and yeah, they share the financial losses too, based on what they put in. It's finance deeply rooted in the real economy.
All right, Section 3. Ethical and business benefits. The 15 key advantages distilled.
Our sources actually lay out 15 distinct advantages to this system, but we've boiled them down into these core themes, all driven by fairness and mutual responsibility. By enforcing ethical investing, the system naturally filters out harmful industries right from the start. And because it's asset-linked and connected to the real economy, it acts like a massive roadblock for wild speculation and the creation of purely artificial debt. Plus, it is incredibly supportive of entrepreneurs. Instead of choking a new business with rigid debt obligations, it offers structures that actually match their real-world cash flows. It's basically an entire ecosystem built to champion stability over reckless leverage.
Now, what's really interesting about this concept is this definition here. Financial justice means that a financial contract should allocate rights, rewards, obligations, and risks fairly. That right there is the absolute beating heart of this model. Islamic banking says no way to a setup where one party gets an unjustified gain while dumping 100% of the commercial burden onto someone else. It fundamentally aligns financial rewards with actual skin-in-the-game ownership exposure and real-world risk. Bottom line, if the bank wants to profit, it absolutely has to share in the commercial responsibility.
Section 4. The African Financial Opportunity, Expanding Inclusion and Growth. So when you take these principles, fairness, asset backing, ethical screening, and plug them into the massive dynamic economies across the African continent, the potential for growth is just staggering. From a macroeconomic level, the wins are huge. First, it blows the doors wide open for financial inclusion, bringing individuals and businesses who historically avoided conventional banks due to religious beliefs right into the formal sector. Second, it uses things like sukuk, which are basically asset-backed alternatives to bonds, to fund vital infrastructure projects without drowning a country in conventional national debt. On top of that, a functioning Islamic finance sector instantly plugs African economies into a gigantic pool of international capital looking for Sharia-compliant investments. And lastly, as we touched on, it gives small and medium businesses a total lifeline, letting them bypass crazy strict collateral rules in favor of profit sharing or leasing.
Section 5. Case Studies in Africa, Grounding the Theory in Reality.
Okay, enough theory. Let's step away from the concepts for a moment and look at the tangible impact on the ground today. The African landscape is wildly diverse, and this model is adapting differently in different nations. Take Ghana, for instance. They are moving straight from discussion into actual implementation. The Bank of Ghana is actively developing a formal non-interest banking framework. Their goals? Driving financial inclusion, sustainable development, and job creation. It's a perfect example of a nation carefully folding this model strictly into its national banking system to give citizens a fresh, asset-backed alternative for financing. Then, if we shift over to the Sahel and West Africa, you see places like Burkina Faso and Senegal making serious moves. Burkina Faso is using this model to offer structural financing that's practically custom-made for agriculture and entrepreneurship, areas where getting conventional credit is notoriously difficult. Meanwhile, Senegal, with its developing financial sector and large Muslim population, is actively building itself into a major regional hub for Islamic finance. They are proving that this model scales up beautifully to handle huge regional trade and infrastructure.
But honestly, the most fascinating case study might just be South Africa. Get this. According to S&P Global Ratings in early 2026, South African Islamic finance deposits skyrocketed by 140%, and advances went up 47% since 2020. South Africa is a mature market, and it proves a really crucial point. Islamic banking can absolutely thrive even in countries where Muslims are a minority. Major institutions there like Standard Bank and Absa are offering highly successful Sharia-compliant solutions right alongside their standard conventional products. And this brilliantly illustrates our point. I mean, 140% jump in deposits over just a few years, that is hard, data-backed proof that when you give people the choice, a massive chunk of the public, regardless of their background, is highly attracted to ethical, asset-backed, transparent financial products. It turns out the quality of the product and how it's regulated matters a whole lot more than the specific demographics of the country. Section 6. The Power of Choice, a Competitive Alternative.
Now, the central argument we're exploring in this explainer isn't that conventional banking needs to disappear. Not at all. It's about introducing a competitive, regulated alternative into the free market. But let's keep it real and completely impartial here. We have to look at the hurdles. No financial system is perfect or immune to risk, and Islamic banking has very real structural disadvantages. Because these products require actual asset purchases, leases, and real ownership transfers, the documentation is inherently way more complex than just signing a simple loan agreement. That complexity can definitely bump up structuring costs. Also, because standard setting can vary by jurisdiction, cross-border transactions can get a little inconsistent. Add in the fact that there are fewer eligible short-term liquidity instruments available for these banks, and it's clear there are challenges. It's absolutely vital to remember that these institutions can still suffer losses, and businesses using them can still fail.
So, what does this all mean? What's the ultimate test for this system?
Well, as our sources highlight, the standard shouldn't just be blind praise because a product is labeled Islamic. The gold standard has to be the evidence. These institutions must provide safe, transparent, competitive, and highly useful financial services. The true power here is allowing citizens to put products side by side and compare them based on cost, risk, and their own personal and ethical preferences. Because at the end of the day, competition drives innovation, and that is a win for literally every single consumer.
I'll leave you with this final thought to chew on. If your bank actually shared your risks and backed your personal values, would you make the switch? By redefining the relationship between a lender and a borrower into a true partnership of shared risk, Islamic finance is offering a seriously thought-provoking alternative. Whether we're talking about the booming markets of West Africa, the mature financial sectors in South Africa, or anywhere else globally, the demand for ethical, asset-linked finance is just undeniable. It challenges every single one of us to rethink what our money is actually doing. Thanks so much for joining me on this explainer, and remember, keep questioning the world.